Make this full screen. Okay. I believe so. Let me just double check that. Yeah, we're good.
Okay.
So a little bit of technical difficulties here, people.
Sorry about
Um,
that, guys.
we apologize. We seem to have lost Jason, either because of Skype or his computer, of course, needed to update, right when we wanted to start this.
So hopefully, he'll be back before we're done. But I just want to start out and say thank you to everyone for joining us today. Like I said, Jason, the president of Keystone Home Mortgage, hopefully will be able to come onto this call. If not, just a couple things that Brandon and I are going to talk about today is the current market, protocols for showings. Berkshire Hathaway has rolled out a new care program that we're going to talk about in a little bit. And then when Jason comes on, hopefully he does, he can talk. Again, Brandon's going to be watching our Facebook page. So if you have any questions during any of this, just ask and we'll get them answered for you. So as far as the current market, these stats are all pulled from the West Penn multi-list. For Mercer County, there's 364 homes listed for sale. In the past week, there's been 35 new listings and 22 homes have gone under contract and then 11 homes have sold. In Mercer County, there's currently 325 homes for sale. The past week, there's been 30 listings and 27 homes have gone under contract and 5 have sold. We're a little bit down from last year, but did you get that, Brandon? Jason, you put that in. So we're a little bit down from last year, but we're still in pretty good shape considering everything that's been going on. As far as Butler County, we are open to do real estate tomorrow. And there is currently 430 homes on the market and 17 have sold last week. So tomorrow, I believe, if I'm right, Brandon, I think so. Almost all of Western Pennsylvania is going to be open for real estate, correct?
Pretty much everything but Beaver.
Other than Beaver. Okay. Hi, Jason.
Hello.
Okay, so we're just going over right now. I'm going to go over protocol and everything that's going on in real estate, and then we can lead into what you want to talk about today. So all of Western Pennsylvania is open except for Beaver. There are some strict protocols that we have to follow, and I'll go over them really quickly with you. There can only be 2 buyers that come to a showing, and only 2 people are permitted in a house at a time. That is even including vacant homes. So either an agent and 1 buyer can go in at a time, or both buyers are able to go in at a time, and this will be determined by the seller. Some are okay with just letting the buyers go in by themselves. Some want the agent to take them in one at a time. Everybody has to wear masks, gloves, and foot covering at all time and practice social distancing. Again, this is also in vacant homes. A couple of things that I've run into this past week, because we have been showing in Mercer and Lawrence County, is sellers can put a time limit on your showings. They can 15 minutes, 30 minutes, 45 minutes. And they can also designate certain days and times that they'll allow people to show their house. So it's just something that's happening, and hopefully we'll move on from it. But there's also 2 forms that might need to be filled out by anyone looking at homes. So don't be surprised if your agent asks you to fill out these 2 forms. Some sellers are requiring it, some are not. A lot of sellers also have been asking for updated pre-approvals for everything.
Jen, before you continue, what does those 2 forms entail? What are they asking on there?
Well, you can help me out a little bit with this one. There's an HSA form, and that is basically the buyer has to answer some questions such as, have you had COVID? Have you been around anybody that has had COVID? Just questions like that.
Yeah, it's just general questions to ask, basically, if you've been exposed to the virus at all in the past 72 hours, I believe.
Correct, correct. And then the PAN is just basically giving permission to view the house, that we're aware that we're in a pandemic, and
It's a liability form.
yeah,
That's kind
it's
of how I
basically
view it.
a liability form. So those might be asked to be filled out. Maybe one of them. Some people are just requiring the PAN to be filled out, not the health assessment.
And just so everybody knows, neither party is required to fill out that form, but neither party, well, first of all, if the seller wants the form filled out and the buyer doesn't want to fill it out, the seller does not have to let you into their house. And the same thing with the buyer. If the seller doesn't want to fill it out, then the buyer doesn't have to go and see your house. So it's kind of a two-way street there. If people don't want to fill it out, they don't have to let you in the house.
Another thing that sellers are asking for is an updated pre-approval, which is what we'll get into with Jason next, just because a lot of things have changed in the mortgage world. So they are going to want you to get an updated pre-approval. That's all I have. I don't know, Brendan, if you wanted to add anything.
No, I think that's the gist of it. As you said, we're starting in the Butler. Basically, Butler County was the most northern county that wasn't able to show the past week. Everything there in south. So starting tomorrow, people are going to be able to go out in those counties. And me and you, we've been kind of already practicing everything we talked about with the masks, the shoes, the gloves. We ask that those supplies are limited. If you have anything that you can bring to these showings, please do, because that's less that we have to try and find for you guys. And also, I think that's it. We understand it's a burden, but bear with us because we're going through the same thing. We're wearing the booties, we're wearing the masks, we're wearing the gloves, we're wiping everything down. We're trying to keep a time limit on everything. Nobody is thrilled about it, but it's what we have to do, and at least we're able to get you into the houses, and that's the important part.
Exactly.
So,
and another thing people don't realize is if you're going to see 4 different houses, you have to change your gloves and booties every time we go into a different house. So again, if you have people are using garbage bags or grocery bags as booties, if you have any of those things, please bring them with you because supplies are limited.
As you can imagine, even 2 plastic bags for every house for everybody adds up really quick. And I don't know about you, but I don't keep that many grocery bags in my house.
I did, but not have a lot of them. Actually, my friends have started giving me them.
Well, good. Yeah, we might need them. So yeah, anybody out there who's grocery shopping, save those bags. Your realtor friend might need them. So Jason, how you doing today?
I'm well. How about you guys?
Not too bad.
Great.
Not too bad.
Thanks for joining us today.
Yeah.
Yeah, thanks for having me.
Absolutely.
So guys, again, this is Jason Livengood from Keystone Home Mortgage out of Butler. He's the president of the company. We brought Jason in today just to talk a little bit about the market, what he's seeing, experiencing. I'm going to go through various different loan types. And if you have any questions as well, like Jen said, I'll be watching the comments, so please ask away, whatever you guys want. So Jason, to lead in with you, kind of a softball question here, but how have interest rates been doing? I know there's quite a lot of volatility there in the beginning. Has that smoothed out, and how is that looking? Probably for the rest of the summer.
Well, a softball and maybe a little bit of a curveball, both all in one question here. Over the last 60 days, we've seen volatility in the rate markets like we've never seen before. As soon as the COVID hit, right before COVID hit in the middle of March, or beginning of March rather, we were seeing most 30-year fixed rates falling somewhere between, say a range of 2.8% and 3.8%, depending on loan type and qualifications. COVID hit, things started shutting down. We saw lenders raise their rates as high as, high 3s, low 4s. Some lenders moved their rates even into the 5% range. And really what that was is it's not a true indication of where rates should have been. It was that certain lenders have essentially pulled out of the market during that time period because of volatility. I think over towards the end of March, there's stats on everything now. And one of the things they keep track of is the volatility of the markets. And in March, I think we had 5 of the 10 most volatile days we've ever had since this thing has been tracked in like an 8 or 9 business day period. So basically, every day we came in, it was like a yo-yo. You might start the day at 3%, go up to 3.7, 3.8 during the day, and then by the end of the day, be back down into the low threes. I've been writing loans for 20 years. I've never seen anything like this. The good news is things have settled down a little bit. There's been some protections put in place by the federal government, which has eased the burden on both mortgage lenders and mortgage servicers. So now we're starting to see things get back to a little bit closer to normal. But of course, we're not out of the woods yet. There's still, excuse me, there's still a lot of uncertainty, and I think still some changes and a little bit of rough patches to come yet as far as the rates goes. Now, the biggest question everybody has probably right now is, what would my interest rate be if I applied today? That's a bit of a loaded question. There's a lot of criteria that go into that: credit score, loan type, down payment, loan amount, and even a few other criteria such as where you're borrowing. It's impossible basically to give an accurate rate quote without a full application and a credit report. But what we're seeing in most cases is a conventional borrower can expect to fall, with a well-qualified conventional borrower can expect to fall somewhere in the low to mid threes with most lenders. FHA rates, VA rates, USDA, they're all in the same range in that low threes. You will find some lenders being more aggressive on a daily basis where they're trying to increase their volume for the day, so they may dip down to a 2.8 or something like that. But that gives you a general range on where they are today. We just did have one program that rolled out on Tuesday of this week that's kind of exciting for extremely well-qualified borrowers. We're seeing the rate range on this program for a 30-year fixed is between 2.5 and 3%.
Wow.
So there's no rates higher than 3% on this particular program. Again, not everybody's going to qualify for it, but those who do qualify for it are going to see a rate like we've never seen before.
What is the qualification for that?
It's basically a conventional loan, primary residence or second home, no cash out. If you're doing a refinance, no cash out. It can just be a rate and term refinance, which is just a refi for a better interest rate. Now, a couple of the other parameters with it. This one's going to sound a little bit funny, but you have to close the loan in 22 days in most cases. So this particular lender has staffed up for this program in specific, and the maximum rate lock on it is 22 days. So if we're going to use this on a purchase transaction, we would either have to move really quickly or hold out to lock in the interest rate, until we were a week or two into the process and could meet that 22-day obligation. That's really the gist of it for that program. It's brand new. I personally have only run 2 rate locks on that because it has only been a couple of days, but I have a lot of colleagues who are using it almost exclusively right now.
Wow.
And that particular program is underwritten within hours. So if we were to submit a loan on that right now, you would be approved by the end of the day.
Any chance they can do that for all of our loans?
Well, that would be wonderful. I would love to give everybody a 2.75.
Yeah, right. That'd be great.
That would even make your jobs easier. That would make homes so much more affordable.
Oh, yes. That'd be lots of good days. So I guess from there, Jason, since we started talking about programs, do you want to just start going through each one and specifically what we're looking at today as far as what people need in credit scores or debt to income, whatever they need to get pre-approved for USDA, FHA, whatever it may be?
Absolutely. And just one more thing on the rate lock that I failed to mention. One of the biggest questions, particularly on people looking to refinance, is, should I lock in now or should I wait? I've heard rates are going to be, 2.75 for anyone in the future. The one thing I would recommend, if you're purchasing a home and you're happy with the payment, lock your interest rate. We don't know where things are going. Most experts are predicting a low rate environment for the foreseeable future, but we've seen expert predictions in the past that haven't actually turned out very well. So if you're happy with the rate, you're happy with the payment, lock it in, take what you got.
Yeah, because I feel like we're still in volatile times nonetheless. So
Well, absolutely, and should we happen to fall back into a second wave of this COVID situation and we're all locked back down again, we don't know,
Right.
what the impact is going to be then.
exactly. All right, good insight there. Thank you, Jason.
But yeah, on the programs itself, one of the biggest kind of rumors among mortgage professionals has been that government lending is dead. That would be FHA, VA, and USDA loans. They're not dead, but they have changed dramatically in the past 60 days. The biggest reason that this stuff is happening is pending delinquency on folks who are out of work and unable to pay their mortgage, and also the forbearances. We have millions of people who have filed for forbearance in the last 3 or 4 weeks, some of which may or may not have even needed that forbearance. And what that does is when a person files a forbearance, it has a ripple effect on the entire mortgage industry because you're not making that payment to your servicer. The servicer is kind of the middleman. I would liken it to if you were the superintendent of a property. You don't own that property, but you're responsible for collecting rent and maintaining that property. So when someone's loan is sold to a servicer or a middleman, and you have to make that payment and you don't make that payment, on these government loans, the servicer has to make that payment to the bond issuer. So if your payment is $1,000 a month and you're not making it, your servicer, whether it be Lakeview or Cenlar or whoever it may be that you're making your payments to, they're actually making that payment to the bondholder, which in this case is Ginnie Mae. So you can imagine when you would take millions of people who all at once are not making their payments, the impact that's going to have on banks. So what they're doing is they were afraid to do any new FHA, VA, or USDA loans because we have a record amount of unemployment that's happening right now, and we have forbearances given out without verifying anybody is actually truly in need of a forbearance, which was a mistake in my opinion, but that's for another conversation.
So to simplify that, basically, even if the borrower doesn't make their payment, whoever is servicing that loan, they're still on the hook for that payment to the bondholders, the government, whoever's backing those loans, correct?
Correct. Now, what the FHFA has done, initially that period where the servicer would cover the payment was infinite. So as long as the borrower didn't make their payment, the servicer's on the hook. A few weeks back, they put a new act in place that limits that exposure to 4 months. So if you're not making your payment to your servicer, they're only going to have to cover it 4 months, and then after that, Ginnie Mae, the issuer of the bond, is going to eat it from there forward. But as you can imagine, still a 4-month payment cover times however many million people are doing this, it's an extraordinary amount of money that lenders are laying out right now.
Right. And I can't imagine if it goes beyond that 4 months, it's going to be any better for Ginnie Mae, correct?
Well, at that point, Ginnie Mae would no longer be on the hook. Well, I'm sorry. Yes, Ginnie Mae would be on the hook, and yes, it would not be good for them. And eventually, there'll have to be a reckoning with that, whether it's higher prices, which will lead to higher rates for the consumers, or there's a lot of negative impacts, none of which are going to benefit any of us in the housing industry.
So really, this comes down to people being able to pay their mortgages and getting back to work.
Absolutely. Yeah,
I have a
and
real
that's
quick question as well
Sure.
about forbearance, just because I heard something, it may be rumor, maybe truth, but I'll ask you because you're the expert. I heard that if you did the forbearance, then you cannot refinance or get another loan in a year. Like in a year. Is that true?
I don't think that has been 100% determined yet.
Okay.
The agencies, Fannie Mae and Freddie Mac, as well as the Ginnie Mae, they haven't given us 100% firm directive on that, other than you cannot do anything while you're in forbearance.
Okay.
Now, rumors are that Fannie Mae and Freddie Mac are going to have a 12-month lockout, but I don't believe a decision has been made on that. And that's actually, I'm glad you brought this up, because this is one of the things that, I kind of wanted to do a short stint on, because many people are offered the forbearance, and we're even hearing rumors of people who are automatically enrolled in forbearance. So all they've done have inquired about whether this is something they can do, and the servicers are putting them in forbearance without their approval in some instances.
Oh, wow. Okay.
Some people think this is a ploy to protect the servicer's asset, because ultimately the game here, and the reason a lot of these services are struggling, is they're counting on those interest payments to come from the borrowers. So if they start not coming in, then the servicers are in a really bad spot, and the people are just taking these, essentially a mortgage vacation, without having a hardship. So what that does is, if there is a 12-month lockout or even a 6-month lockout where you can't refinance, that servicer is now protected to where you cannot refinance their loan. So what it does is it solidifies the value of their asset, because they know they're going to maintain that for at least another year where you can't refinance.
And they're going to continue to collect the interest rate and fees, whatever it may be.
Correct. So by taking that short vacation, you may void your opportunity to take advantage of what may be the lowest rates we've ever seen, in the near future.
And in your opinion, Jason, how well explained was this to consumers by banks?
Terribly. I think the whole thing from, the crisis that is, and a crisis, it is a crisis that's happening in the mortgage world, could have been averted with just a few changes in the way things were done. I mentioned the FHFA enacting that rule. Had they done that, 3 weeks prior to when they actually did it, our worlds would really not have changed much at all. What happened was these banks are bleeding money for a month, making these payments for people, and then also they're getting hit with margin calls on the other end, to honor people's rate locks. This all could have been avoided, and it kind of all rolls into one giant ball, because the forbearance piece of it just creates fear among the servicers. Because, if you have 10 million people tomorrow that decide they don't want to make the payment for 6 months, and you're not requiring them to show proof of a hardship, you're setting yourself up for a bad day in the future. But yet, most people had no idea, and I'll be honest with you, we still don't know all the details. 45 days after this program has come out, we're still trying to iron out exactly what the effect is going to be on the consumer.
Yeah, and like you said, a bunch of expert opinions out on there, but they never seem to be completely right, and it'll be interesting to see still how this pans out. It seems to be getting better, though. Would you say that?
I do. I do think it's better. Now, there's still some lenders who are going more conservative. We have one of the lenders I work with regularly on Friday. They're raising their FHA and USDA and VA minimum to a 680. They were 580 a month ago. So we still see some contracting of the credit markets, but in general, I think we're going to start seeing some loosening of what's called an overlay. So basically, the government-sponsored entities, Fannie Mae, Freddie Mac, or FHA, VA, USDA, they lay the groundwork for who can be approved for a loan. And then each bank has the right to kind of water down those guidelines a little bit to whatever they want. So if a bank doesn't want to allow a debt ratio over 40% or wants to make sure you have 6 months of payments in the bank after closing, they can enforce those rules. They're called overlays, and there are a ton of them right now due to COVID. Things as crazy as if you're a first-time home buyer and you can't provide rent checks, you can't buy a house. Or if you don't have 6 months worth of payment in the bank after closing, you're disqualified. Those things are starting to be pulled back now. Another big one was self-employed people. In the past, we had to automatically discount their income by 25%, which is a huge reduction. And that's just due to the fact that common sense tells us they're going to not be working for 3 months out of this year. Those limits are now either being pulled back to no reduction or a 10% reduction for some lenders. So I think we are seeing the other side of this. We are starting to see some light at the end of the tunnel, and maybe where we can get close to being, back to some sense of normalcy in lending.
Now, Jason, I have a kind of a specific question for our region in general, or even just the state, because one of our states is one of the more tougher ones on businesses and real estate and things like that. Are there other areas where this hasn't had this effect? I feel like Ohio, I have friends with realtors and stuff on there. It seems like they're able to still operate and do these loans okay. Are we just feeling this harder here compared to other places, or is this pretty much blanketed across the country?
The overlays and the changes in credit score requirements and all of that stuff, the volatility in the markets, that's being experienced industry-wide. Now, the only things that we would see for an area that's been hit hard by COVID or an area that's restricted by, whatever policy it would be, for a shutdown, there have been exceptional circumstances in those areas, with appraisals. For example, everything moving to drive-bys because we don't want appraisers entering anyone's house. So we haven't seen, with me only operating in Pennsylvania, I'm kind of limited as to, the scope of the effect outside of our state. I do have some friends in other states who were not hit as hard by COVID, and they have essentially, they've been working as they were before it hit, but still under these same restrictions. So while their appraisers could go out and inspect homes and go inside and they don't have to do drive-bys and everything was a little bit easier and not as many people were off work, they're still following the same restricted debt ratio, higher credit score requirements, all of that it's not regional.
So I guess that could lead into my next question. How is this affecting people who have lost their jobs? Maybe just coming back onto the job, maybe even people that were under contract and lost their job and have to get their employment re-verified. How is that affecting people, and kind of what is the regulations there?
Anyone who has had a negative effect from COVID, we have to, if you're off of work, we have to have a firm return date guaranteed by somebody in HR or payroll. And in some instances, we have to have a pay stub showing that you're back to work. Now, as far as calculating the income goes, everything is kind of being treated as a case by case in this situation. If you're straight salary, it's pretty simple. If you're straight hourly at 40 hours per week, that's also pretty simple. Where the complicated cases come in is when you have somebody who might receive a bonus or overtime or commission or maybe a shift differential. That's the income that's going to be a little bit harder to include on the applications now than it was in the past. Because we look at both historical data, 2018, 2019, and year to date, and then we average those together typically. But now what's happening is your year-to-date income, the overtime, the bonuses are going to be considerably less. And as of right now, they are using basically a worst-case scenario. So if your overtime or shift differential has been chopped because of COVID, that is now your new income until you're back to work working regularly, and we can see some consistent
So
paychecks showing
no
up.
exceptions. Whatever's your current situation is your current situation. You're not.
Pretty much.
Yeah.
Yeah,
Okay.
there's been, although I get this question, in this statement a lot of, I can't believe they're not giving more exceptions, given the circumstances, but quite frankly, it's went to the exact opposite. The ability to get an exception made on a file is now pretty much non-existent because there's so much fear out there.
So I just want to ask a quick question about loans. Go back on that. So renovation loans and construction loans, what's going on with those? I know the reason I'm wondering is last year we did renovation loans together and they got pretty popular. And for those of you who don't know what a renovation loan is, it is when say the house that you're buying needs some work, you can roll the cost of that work into your mortgage. That's a very brief, generic description.
Yeah, and also very accurate. It's a great program, and right now, about 80% of the lenders who offered it have temporarily suspended it. There are still a few players out there who are doing them. And the reason is it is considered a higher risk program than a standard conventional or a standard FHA, simply because you have more moving parts. When you're just buying a house, you buy the house, you go to closing, you're done. You get the keys, the deed's in your name, it's over. When you're doing a renovation loan, you're hiring a contractor, who's providing services post-closing. And in a lot of cases, these loans don't actually close out until 3, maybe 6 months, up to as much as 12 months after your original closing before it's put to rest, because it may take that long for the renovations to happen. So yeah, that's unfortunate because it's a great program, especially when you're in a thin market like we have been for, what seems like 3 or 4 years now. It would allow you to go in and find a house that may not be perfect, and you can make it perfect with those renovations.
Just with the low inventory last year that we saw, I did more rehab loans last year than I've done for as many years as I've been in real estate.
Yeah, I would agree. In the last 2 years, I've done more in the last 2 years than the previous 18 years combined.
And then same with construction loans. They're kind of in the same wavelength as the rehab loans right now.
They are. And construction loans were harder to find to begin with. They had an even smaller pool of lenders that offered those. So now, while there are still a couple, in my wholesale channel, there's a couple of lenders that offer it. But right now, that program, and I hate to say this, but that program is probably best suited for a local bank or a local credit union who has a program in place that hasn't been affected by COVID.
Okay. That's all the questions I had. Did you have any, Brandon?
I think that covers about anything that I had questions on. Jason, is there anything that we missed or that you want to touch on?
The only thing I want to touch on is there's been a lot of bad that we've been talking about here, and I'm sure people are really sick and tired of hearing about COVID and being locked down and all of this stuff.
I agree.
There's a lot of reason for it. A lot of people ask me, why is all this happening, in lending? The short thing that I will say about it is, we have, I think it's like 26 or 36 million, I think it is now, 36.5 million people on unemployment in the United States right now. 20.5 million people filed for unemployment in April. 20 million people in 1 month. I mean, it's astounding to think that that's possible. Now, the little bit of the silver lining, in the month of April, when we had that huge spike in unemployment cases, of that 20 plus million that filed, almost 18 million of those jobs, excuse me, were considered temporary layoffs. Okay, so what that tells us is there's a large percentage of these people that are off right now that are going to be going back to work soon, hopefully. When that happens, we're going to return to normalcy, not right away, But in phases, we're going to start seeing life return to normal. And that's everything from going to the grocery store to get a haircut, to getting a mortgage or going to see a house. I think the key thing here in closing is we need America to go back to work. As soon as more of us are able to get back to work and start earning and, stop relying on, the stimulus checks and all of this stuff to come in, I think we're all going to be happier. And we'll finally be able to. I mean, I can't tell you how bad I just want to go to a restaurant and eat a meal. Those simple things that we kind of take for granted.
Yeah.
You miss them after you can't do them for 60 days. But there is light at the end of the tunnel. We do have a silver lining here. Of course, everybody in the world is working on a vaccine or a treatment for COVID. I think ultimately that's going to be what's needed to return to 100% normalcy. But I think at this point, I'll take 50 or 60%, based on what we've been experiencing. So that's it. Yeah, a lot of bad in the last 60 days, but there's definitely good to come. When we get on the other side of this, we're more than likely going to be in an excellent, great environment. Real estate values are not going anywhere. The difference now versus 10 years ago is now we have a health crisis. 10 years ago, we had a housing crisis. Two totally different things. So as soon as the health piece of it is solved, we go right back, close to back to normal on the housing end of things.
Yes, people, that does not mean that you can lowball sellers, because it is not the case at all.
No, our inventory is still low. But for anyone who's thinking about selling their house, please get a hold of us, because I have a ton of buyers and I've been showing houses like morning till night for the past, week has it been almost?
Yeah, so many buyers, guys. We need more inventory. If you're thinking about selling, I understand not everybody might be in that situation yet, but even if, in a month, if you've been thinking about it, it's still a good time. There's going to be tons of people probably interested in your house if it's good. So,
and I kind of want to roll that into that has to deal with the Berkshire Hathaway Cares program.
Yep.
So I don't have all the details yet. Brandon and I are going to be doing these Facebook Lives every week. So I'm hoping I have more detail for you next week. But what the program is that if you list your house in May or June with us, you will be entered into a drawing to win up to $10,000. That is when your house sells, and I believe it has to sell by the end of the year. But it's just kind of a little incentive to help you. If you're on the fence about listing your house, you should do it, because you could win, to $10,000.
Yes, that's an awesome thing that Berkshire is doing. To try and kick off the local market. A little bit, and every once in a while they'll do a little contest like this, but I think specifically they're trying to make sure that people aren't afraid to sell their homes, and you shouldn't be. As Jason said, the other side of this looks fine. We're dealing with a health crisis, not an economic or a housing crisis, and we definitely need more people to sell, because we have people that have been working with for a year, 2 years, like seeing so many places, but just not the right one for them, and sometimes not even showing people houses because they can't find anything at all. It kind of depends on your area. I know specifically in the school district I live in, it's almost impossible to find a house or see one and not have it be on the market for less than 5 days, because everybody's looking in that specific school district. So definitely, if you're thinking about it, please reach out to us. Also, again, Jason, thank you for coming on.
Absolutely.
Jason Livengood. His name or his Facebook page has been tagged on our post, so please take a look on there. I'm sure, and Jason will be happy to answer any of your questions, and also help you if you're not quite ready yet. He'll help guide you in the right direction. And Jen, is there anything else you want to add before we get off here?
No, I think I'm good. Again, we'll be having another one next week. I think we're going to try to keep it Thursdays at 1. It seems to work out.
And we'll try to have this a little bit more smoothly as we go along with this, guys. Technology has not been agreeing with us this last couple times, but we will get this smoothed out. We are realtors, not video producers, although I'd like to think I am sometimes. So,
I definitely don't think I am.
So I guess with that said, guys, if you have any questions for me or Jen, leave them in the comments or message us. And if you have any questions for Jason, you can contact him through his Facebook page as well. Jason, anything you want to say before we get off here?
No, I think that's it. I appreciate you guys having me on. Everybody stay safe, and I am so happy that we're almost back in business.
Almost, yes.
Me too.
Yes. All right. See you guys.
Thanks,
All right.
everybody.